Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from the Canada Pension Plan. The returns were helped by holdings in public equities and real assets. The results fell short of CPP's benchmark portfolio, which returned 13.2% for the same period, boosted by heavier exposure to large tech companies. Shares of IBM are up in the pre-market. The American company will receive a $1 billion U.S. Agreement as part of the Trump administration's investment in quantum computing. The government is pledging a total of $2 billion U.S., with a grant also going to Global Foundries, which is developing specialized chips for quantum computing. Funding will give the government a stake in the companies. Shares of Deere are trading lower in the pre-market. The heavy machinery company saw a 14% drop in sales of its production and precision agriculture business. The American company has struggled from an extended slowdown in the tractor business, with farmers cutting back on bigger purchases amid higher interest rates and a challenging farming market. On the upside, Deere boosted its 2026 guidance for income from financial services. And taking a look at the markets, you can see a little bit of a give back today. Concerns over what's unfolding in Iran, that maybe the peace talks aren't going as well as the president had said. You see the Dow's off by about 0.29, the NASDAQ by 0.62, NVIDIA earnings as well, dragging that down a little bit. S&P 500 also off. TSX for the year still up 31.53 from yesterday. It was a big gangbuster jump yesterday, which was nice. We'll see what happens with it today. Probably expect to follow the Americans as well. Oil on its way back up after a couple of days of dropping. Its WTI is up 2.8% and back over $100. As for gold, it's going the opposite way, still hovering around 4,500, but off by about a half point today. And the Canadian dollar down slightly at 72.59. And one last one to note. Bitcoin down about a half point. It's around the 77,000 mark. It's been hovering around that one for the last, it looks like about the last month or so, trying to figure out which way it is going. Well, U.S. stock futures are lower in part, weighed down by less than expected enthusiasm over NVIDIA's blowout first quarter earnings report. Let's get more from Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth Management. Michael, thanks very much for joining us today.
My pleasure, Roger.
What's NVIDIA got to do to make people happy?
I'll tell you what, it's tough to know. It's really reminiscent of almost like watching Tiger Woods at his prime. No matter what he did, people are like, it's kind of boring. I mean, they had a huge blowout quarter, both on earnings and revenue, buying back a ton of stock, raise the dividend dramatically. I really don't know what else you could do. The good thing is I think it signals that the rest of the world that AI is still very much a big theme and should be invested in accordingly.
Are there any legitimate concerns? Is it competition? Do investors see some competition on the horizon?
I think ultimately there has to be some competition. I mean, they're not going to keep the level of market share, but this is such a big, growing, expanding marketplace. Even a little bit of market share erosion is not going to hurt them. I mean, they can't make chips fast enough, and I don't see that changing for the foreseeable future. So I think it's still a stock that you want to continue to own. And if you don't own it, shame on you. But if you don't own it, you probably need to take any weakness to get some exposure.
And is that backlog a good thing, or could it hurt it down the road?
Most times backlogs are good. I mean, ultimately what ends up happening is it sorts itself out. But I think longer term, the backlog is going to, unfortunately, more competitors will come in. They'll start to figure out ways around it. You don't want to wait 4 years for a chip. But again, they can't make enough of it right now. And 50% of their business is to the hyperscalers, those big 5 or 6 buyers. And so that's still a very strong endorsement of NVIDIA's chip and their technology.
All right, and bigger picture with the S&P 500, 90% of the companies have reported at this point. What's your report card on their reports?
It's amazing. This is the sixth straight quarter of double-digit revenue growth, but this is actually the best quarter. I think we're at 27% year over year, and I think and Nasdaq's even higher than that. So a very, very strong quarter year over year for growth, and I think a lot of people underestimated the ability of corporations to earn money, given the fact that we've had, tariffs over the past year. Recently we've had a war. So I think there's a little bit of underestimation of the power of this market.
And with that war, I think we saw that initial sell-off when it started, but now it seems people have just kind of baked it in. And is there something from that? I mean, today we're seeing a little bit of a pullback, but is there something, would it have to explode fully back into an actual, what do they call it? Kinetic war. That's the term they're using now. Would it have to go back to that to have an impact on the markets?
Yeah, I don't know. I think right now what's happened, I think people have overestimated or underestimated the impact longer term of higher oil prices. And we think commodity prices are on the move higher. Oil basically affects everything. And although it's higher, if there was a peace treaty tomorrow, the strait doesn't open tomorrow. So I think you still got this, overhang of lack of oil around the world for a short period of time. Strategically, it probably is better for the U.S. as a nation for it to go longer, because I think the warring factions inside Iran are here. I don't know who's running Iran, and I'm not sure they do either. That probably is a different story than market-wise. But anytime there's this kind of a skirmish, I think people have underestimated, the longer-term effects of it. I think it's partly from last year. The market, a lot of people missed the rally because of the tariffs. And I think people are like, hey, I'm staying in this market regardless of kind of the bad news that we're seeing over in the Middle East.
And could gas prices play a factor on this? Could that derail the economy?
Yeah, certainly. The U.S., interestingly enough, is now not really reliant on any oil from the Strait. So I don't necessarily see it getting to the point where it derails, the economy per se. But does it certainly hurt some portions of the marketplace? Absolutely. The U.S. economy is 70% consumer driven. And if you see a 30-40% increase in the price of oil, that's 30 or 40% less they can spend somewhere else. So I think it's definitely a possibility. And there's some of those stocks that don't have, or companies that don't have pricing power. I think there's a concern there that, what are we going to get from that? So there is a possibility the longer it goes on, the more it could, ultimately slow growth. I just don't see it at this point.
And you do see some pockets of opportunity, though.
Absolutely. I think what's happened is I think the overall AI trade, for the most part, I think people own a lot of chips. I think you need to continue to diversify. We like some things that are kind of outside of that space that aren't trading at kind of all-time highs. One name I like is Rolls-Royce. One of the leading power makers in the world for engines. And there's only 4 real makers of engines in the world. Airbus's CEO is on, recently stated they can't get enough engines. It's a similar problem to the chip scenario. And so you've got that scenario where you can't make enough engines fast enough for the buyers. That's a positive. Also, they've got record profits, and they do have, obviously, power generation is going to be big for AI. This is kind of an AI adjacent play. Anywhere you can get power is going to be positive for the AI story. So I think it's a name that we like. It's not trading at all-time highs. It's a name that's not owned that much. People still think they make the cars. Yeah. They don't. That's a BMW division that actually owns that. This is the engines, the nuclear, and the aerospace. And I think it's a good story, under-owned, underappreciated.
All right, jet engines running data centers. I have a good visual on that. Viking Holdings is the other one you like as well?
We love Viking Holdings. And I kind of talked about, the gas prices hurting people. The gas prices don't hurt the typical Viking customer. They're wealthy. They go on trips. They're planning their travel, and they're doing what they want to do. Viking caters to that. It's a 55 plus, no casinos, no kids. It's high end. It's expensive. You get what you pay for. But they provide a very, very high quality product, and it continues to do well. Bookings they're looking at 28 and 29 bookings already. All 7 continents, big ships, little ships, and they do it all. And again, they've got a small market, and they focus exclusively on that small market. What I've liked here recently is when I like to talk about stocks, it's pulled back a little bit because the oil prices, as you mentioned, are higher. It gives you an opportunity to pop into a name that longer term, again, oil prices aren't going to affect the prices here that people are willing to pay for this product. It's a high-end product. Got a lot of clients that go on that line, and they love it. They're repeat buyers, very high customer loyalty.
Okay, and last one, the Ensign Group.
Yeah, this is kind of we have a kind of a couple themes in that we use, obviously AI being a theme, cybersecurity. The other one we have is kind of the aging populations. The North American aging populations are big. They need more care, whether it's acute care, skilled nursing. Ensign's a smaller name in the space. They operate 300 hospitals in 17 different states. People are living longer. They need more care, more therapy, things like that. It's a good business that isn't going away anytime soon. The old days of when people retired at 65 and died at 68 isn't happening. People are retiring in their early 60s, living to be 95 years old, and they need therapy and care and different levels of it. They're at kind of a great spot for that, and it's traded off a bit. It's up over the last 12 months, but if you've noticed since March, it's traded back a bit to give you an opportunity, I think, to get in to an area that you could own for 3 to 5 years because that space is not going away.
All right, we got to wrap it up there, Michael, but thanks as always for joining us.
My pleasure, Roger.
Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth Management. Coming up, we'll bring you an in-depth look at the markets, and then we'll hear about Airbnb's latest effort to expand beyond short-term rentals with other offerings. All right, let's see how things are shaping up on the markets just before the opening bell. We'll start with the U.S. futures, and all of them are in the red. You can see the NASDAQ off by 0.61. NVIDIA's earnings, not enough. They are taking a hit. Walmart also coming out with earnings today, decent, but saying, warning that fuel costs are squeezing the company's bottom line and could lead to higher prices for shoppers. Over in Asia, let's see what the markets did there. The Hang Seng was off. CSI 300 off by 1.39. The Nikkei, though, look at that, 3% it was up. And also the Kospi in South Korea surging on semiconductors there. It's been going gangbusters this year. In Europe, it is a red day there as well. FTSE off by 0.29. The CAC 40 by a half point, a little more than that. The DAX is off by 0.64. Concerns over what's unfolding in Iran and the talk, maybe the peace talks aren't going as well as President Trump had said they were, or thought they were. And the TSX, of course, it had a gangbuster day yesterday, up by 1.25%. And some of the movers for that yesterday, the winners on the winner's side, we've got Go Easy that was up by 11.8%. Of course, it has been up and down over the last few months on its earnings report that really sent it for a loop. Perpetual Resources up by 11.5%. Vermilion off by 4.6%, and Strathcona Resources off by 4.9%. And the metals, all of them in the red right now, and gold just dipping below, it's right around the 4,500 mark, we'll say, 44.99, off by 0.79%. Silver, which has been enjoying a little surge in the last few days, backing off by 1.4% at 75. And copper is down by 1.28. It's been on a nice little rally as well. It's down to 6 1/4. Western Canadian Select from yesterday, it dropped 5.7%. We'll see what it does today on the news, of course, what's unfolding in the Middle East. It's at 78.56 is what it closed at. And taking a look at WTI for today, not surprisingly, it's going up after a couple of days of pullbacks. It's up by 3.7%, back over 100 at 101, almost at 102 right now. And finally, a look at Bitcoin, off by 0.65%, right around 77,000. It's been around this area for the last month or so. Well, Airbnb is planning to let guests arrange luggage storage, airport pickups, and car and equipment rentals on its platform. Its latest efforts to expand beyond short-term rentals. For more, we got perspective from Airbnb CEO Brian Chesky. He began by explaining why this is just the start of the company's expansion plans.
4 major services: groceries, airport pickup, luggage storage, and car rentals. But what I told everyone is just the beginning. You're going to see dozens of more services. And what we're building is an ecosystem of services for every part of your trip, from the time you arrive to the time you leave. It is a little bit like an app store in the sense that we're working with the developers. We want to create really great integrations. We want to create great guidelines. And mostly, to answer your question, we're looking mostly at partnering. We're always going to be open-minded about acquisitions, but we really want to elevate these partners around the world. And so we have some great partners today, and we really just want to be a great partner to them.
The reason I asked it that way, Brian, is like strategically in the past, you've done some deals. I'm thinking like hotels tonight, or like even areas you've divested from. What am I thinking of? Tickets, tour booking, right? But hotels is really interesting here. 20 markets for boutique hotels. I would look at that and say those are also markets where there are some limitations on short-term rental. But what's your pitch to the boutique hotel industry? Why Airbnb as a partner?
Well, actually, it's really interesting. They're pitching us, which I was very surprised by. And why are they pitching us? Well, because many of the boutique and independent hotels, by the way, if anyone's wondering how many there are, about 60% of the hotels in the world are boutiques and independents. Boutiques and independents don't get the same deal that chain hotels get, because chain hotels like Hilton and Marriott have points programs. They also are able to negotiate with Booking and Expedia lower commissions than boutiques. And so what we offer is a flat 15% commission on boutiques and hotels. We've got this great merchandising for them. A lot of boutique hotels, especially in Europe, love that we have American travelers, we have younger travelers, and we're just really built custom for them. And so they ultimately want more demand of young travelers in particular, and that's what we can offer them.
Changing consumer behavior, so hard. Or rather, bringing new behaviors from a consumer, so hard. Like I'm going to Paso Robles, right, in June. So if I book an Airbnb, okay, maybe it makes sense if I do the wine tasting experience with it. But with all the new things you have, how do you actually get people to make use of that?
You know, it's really important that we personalize the app. So like some people want to participate and go do a cooking class or do a food tour on their vacation. Some people just want to relax and they want groceries delivered for them and they want everything taken care of. The most important thing is that we have a deeply personalized service. So with a new homepage, the app really learns about you. With AI, we can start to understand your preferences. But my vision is eventually every person they open Airbnb sees something different than something else based on what they love. And I, over time, want the app to feel like it knows you. You know, we're in the hospitality business. Our app is only as good as the sense that it feels like it knows you and is personalized to you. So even if one day we offer 100 different categories of service experiences, we don't want to throw 100 things at you. We want to know the 5 things you really care about.
Since the beginning of May, I've been reading completely inconsistent reports about travel demand for the FIFA World Cup, particularly from the hotels. What is Airbnb seeing for those coming for this World Cup?
I mean, we are anticipating the World Cup will be the biggest event in Airbnb history, and we're seeing a similar travel pattern as the Milan Olympics. More than 60 days out for the Milan Olympics, it did not look like the demand was going to be what we anticipated. And then something unexpected happened. We had a surge of demand within 60 days of the beginning of the games, and 200,000 guests stayed in Milan and Cortina for the Olympics. So what we're seeing is people booking more last minute, but we are still seeing a huge amount of demand for the World Cup. So to answer your question, we are expecting it to be the biggest event in Airbnb history.
You spoke to my colleague and friend, Natalie Leung, about Chinese AI models and a misunderstanding of how that works in practice. But I just wanted to clarify, is Airbnb still using or relying on some of those models, Qwen or even newer ones? And is that the open source opportunity, or is that the sort of cloud-based API where you're a customer of those companies?
We are not a customer of those companies. We're using a variety of different open source models. I just want to say a few things about this matter. Number one, data and privacy is most important to Airbnb. I think anyone who knows Airbnb knows we have an outstanding track record on data security and privacy. Number two, all of our data is vaulted. No company has access to our data. It is vaulted in Airbnb. Number three, the congressional committee has reached out to us. They said they have some questions. We said we want to cooperate, and so we're in direct contact and cooperation with them. And I think before I answer any more questions to the public, I want to make sure that the congressional committee hears from me directly.
That was Airbnb CEO Brian Chesky. Up next, a high-stakes meeting between the Prime Minister and BC's Premier over a controversial pipeline deal. More after the break. A face-to-face between the Prime Minister and the BC Premier yesterday, who has been critical of the agreement signed last week between the federal government and the Premier of Alberta that could see a pipeline come through starting next year. CTV senior political correspondent Michael Couture has more.
but that the Prime Minister is a friend to British Columbia.
BC's premier struck a friendly tone standing next to Prime Minister Mark Carney. It came a day after David Eby said Canada won't work if separatist premiers get all the attention. A reference to Alberta and Ottawa moving forward on the plan for a pipeline to the West Coast.
Developing our economy has to go hand in hand with environmental protection for the next generation, including the North Coast tanker ban.
Carney pointed out 1/3 of the projects identified as in the national interest are in BC. He also told the Vancouver Board of Trade he's looking for partners, not pushback.
We don't want to hear what people are against. We want to hear what they're for. And if you're for something, we will get behind you.
Carney's challenge is to sell that message while balancing the competing interests of each province.
I think what he's doing is he's saying, look, we are going to establish rules that will propel forward major projects, create jobs, and generate benefits for each province, for each part of the country.
Part of that balance includes working with provinces like Saskatchewan to apply the industrial carbon tax, which Premier Scott Moe is seemingly open to discussing.
To see if we can come to some type of an agreement that works for industry and doesn't impact negatively the industries that are creating jobs and making investments just like this in this province.
Carney and Eby have agreed to start negotiations on BC's economic priorities. However, the Prime Minister also told that Vancouver business crowd if things get stalled there, his government will spend time in the rest of the country because they need to move forward.
CTV's Mike Lecouture. Okay, one stock we'll be watching at the open is Walmart, and here's why. Shares of the world's largest retailer are down right now in the pre-market, 2.66%. It missed profit guidance for 2027 and has some concerns. Walmart warning that fuel costs are squeezing the company's bottom line and could also lead to higher prices for shoppers. Now, in the latest quarter, the world's largest retailer said comparable sales in the U.S. stores were up 4.1%, excluding fuel, slightly better than what Wall Street analysts were expecting. The results show the company continues to gain market share across income levels with its focus on the low prices, fast delivery, and wide assortment. But that emphasis on affordability is facing pressure as inflation accelerates and the conflict in Iran drives up the prices. And so the company, right, as we mentioned, is down 2.9%, but it's up 17% for the year. Coming up next, the opening bells. There you go. There are the opening bells at the NASDAQ. Air Global PLC ringing the opening bell as it joins the NASDAQ today, first day of trading. And if you're wondering what it does, it is the global leader in flavored shisha molasses and a pioneer in advanced inhalation technologies. It starts trading now on the NASDAQ. And at the New York Stock Exchange, Citi ringing the bell to celebrate Asian Heritage Month. And on the TSX, West Fraser Timber celebrating the company's 40th anniversary of being listed on the TSX. Time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity markets and see how things are going right now. And the TSX, no surprise, it's continuing from overnight. We saw in the pre-trading that TSX, it's off by 0.38, S&P 500 off by 0.43, NASDAQ by 0.52 as well. All of them down. Looks like it may stay that way for the day. We'll see. So the stock we want to keep an eye on, Lightspeed, reporting a mixed quarter with revenue rising 15% year over year to $290.8 million, beating expectations. Adjusted earnings fell short at about 8 cents per share. We'll speak to the CEO in the next hour about that. Right now it's off by about 8 1/4. And for movers south of the border, we are joined now by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. And Jeff, thanks as always for joining us.
My pleasure. Thanks for having me.
Okay, everybody talks about AI, and we're still trying to wrap our heads around it. Now we're getting into quantum computing, and I don't think we have arms big enough to wrap anything around it. It's a fascinating field, and the White House looking at a potential there.
You're right. Yes, yeah. We're very quickly moving from AI to quantum computing, and the White House is trying to kind of provide grants and invest in what will be potentially this next kind of iteration in kind of the digital evolution, I guess. And that what they're doing here is they're looking at kind of an older stock, IBM. IBM is one of the top performing stocks in the S&P 500 so far this morning because it is getting a $1 billion grant from the White House and from the Trump administration to build a new foundry that would make quantum computing chips. This is part of a $2 billion initiative that the administration is kind of embarking on to try to build out this quantum computing business and infrastructure in the United States. But it does look like, the bulk of that, $1 billion, is going to go to IBM. In turn, IBM is going to invest $1 billion in a new company called Anduril, which I suppose is a going to be in the quantum computing game. But as you said, yes, I have barely wrapped my own head around AI and how that works. And making the leap to the quantum realm is not something I'm capable of doing just yet.
And especially this early in the morning. Did the White House give any particular reason as to why they were going kind of old school rather than cutting edge? Yeah, they did not specifically kind of explain, there are other companies that are getting grants. Why IBM is getting the big one potentially has something to do with its own fiscal capacity in terms of being able to kind of invest here. Also worth noting, the White House has invested in a handful of other kind of old school tech companies, including Intel, which has really had a sharp run after receiving some money from the Trump administration. So potentially it's a return to the greatest hits, or potentially it's just that IBM has the capacity to build out this foundry. All right, Intuit shares are off on their outlook and the results and job cuts. Sounds wonderful.
And job cuts. It's been, the kind of kitchen sink morning for Intuit. Intuit, this was their fiscal third quarter and quite a disappointment in their TurboTax segment. So TurboTax obviously is that kind of subscription-based software. Some people log in tax season, do their taxes, and then don't think about it again until the next tax season. This segment is a big, important one for Intuit, and it was a big miss in the quarter. So yeah, we're looking at shares down 15% today. RBC Capital Markets out with a note this morning that kind of described how rough of a miss this was. And Citi indicated in a note that this might be an indication, perhaps, of a little bit of a loss of market share. Also noting that the margins were not quite as good as analysts had expected them to be. So that, in addition to the fact that the company plans to lay off 17% of the workforce, there are some jitters on Wall Street and among investors, and this is the worst performing stock in the S&P 500 so far this morning. All
right, we'll wrap it up there, Jeff, but thanks as always, sir.
Thank you.
Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Coming up, oil is trading higher this morning as investors wait to see whether the U.S. and Iran will make progress on a peace deal. Both sides have indicated that they are closer to reaching a deal, but there has been nothing concrete announced. That's next. Well, oil prices are higher this morning as investors wait to see whether talks between the U.S. and Iran will translate into a tangible peace deal. Joining us now to share his thoughts on the Canadian energy sector in the wake of this conflict is Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Ryan, thanks as always for joining us.
Thanks for having me, Roger.
All right, just thoughts on what's unfolding over the last few days in Iran, and is there reason for optimism, do you think?
I don't think so, actually. Obviously, the Trump administration, the U.S. government, I think would like to be done with this, but I just don't think it's that simple. And they can't retreat in a way that sort of makes them look bad, right, and makes them look weak. And if they were to retreat now, I think Iran would have more control over the Strait of Hormuz than the global community wants. And so I think it continues to be a bit of a stalemate.
And so where does this, we saw oil retreat for a couple of days. It looks like it's on its way back up today. Where does this leave the Canadian industry?
I think the Canadian industry is in great position. And oil prices aside, I do think that eventually we will get some resolution here, and eventually barrels will start flowing out of the Strait of Hormuz, and things will be somewhat more normalized, although I doubt we're going back to the 20 million barrels a day. And so with that in mind, the Canadian industry has a great opportunity here to expand egress potential. Now, things are back on the table. We have a modified Keystone XL back on the table. But the thing that I'm much more excited about is on the natural gas side and natural gas export. I think this crisis is much more acute in gas because of the lack of storage capacity for natural gas and just the way that commodity moves around the earth, and how concentrated supply was in Qatar. I think the world is now looking for more points of supply, and Canada has a big part to play there. And I think with Shell coming back into Canada is a big vote of confidence that says, hey, there's going to be some more investment in the Canadian industry, and that is exciting for us as infrastructure owners in Western Canada.
What would you like to see Canada's role in natural gas, or Canadian companies, their role for natural gas?
I mean, I just think we have such an opportunity. I think we could be an exporter of 5+ BCF a day, billion cubic feet a day. Right now, we're a little over 1 with LNG Canada Phase 1. So LNG Canada Phase 2, we have Cedar LNG coming online, a smaller project. Wood Fibre, there's a few smaller ones. There's an Indigenous-led project as well that's quite large. I think we could do all of them over time, and that would be, we have abundant natural gas supply that's very, very economic. We have a shorter shipping distance to Asia and a cooler ambient temperature, which means that there's less energy required to cool the gas. So, longer term, we really need to get something going east as well, and that's another opportunity. So, if we're actually in a position where the existential threats that have been presented to us by the U.S. With trade negotiations over the past couple of years, and just what's happened with the global energy sphere, I think Canada has a big opportunity to play going forward, and hopefully we're ready to do that.
And let's talk the pipeline for a sec. That the agreement that was signed between Ottawa and Alberta, and then the Prime Minister was in BC yesterday trying to make amends there and try and mend fences, because that's a roadblock for it. Do you think he can work through that? Do you think we can get that pipeline through?
I don't. I'll believe it when I see it. This is a fool me once, shame on me, fool me 100 times. You can't keep going down that road, right? So I don't think we're going to see a greenfield West Coast oil pipeline built, and I don't necessarily think we need one. I think if this Bridger pipeline gets done into the U.S. and that would be more than enough to satisfy demand for quite some time. It would be better for us to diversify our customer base and have more going to Tidewater, but I do think that the road is just too difficult for any private company to take on, and therefore then you need government guarantees, and then we're into how long do terms last and who's in charge of the province versus the federal, and we're into a bit of a mess there. So, again, never say never, but I'll believe it when I see it.
All right, let's talk about some of the names you like. Enbridge, AltaGas, Pembina Pipelines. I always want to say Pembina Pipelines. What do you like about them?
Again, I just think that all of them have opportunity here, especially, Pembina and AltaGas on the natural gas side. There is, really strong demand in Asia. Asia has had cargoes bid away from them now twice by different crises. First, the Nord Stream and Russia-Ukraine crisis, and now the Iranian-Qatar crisis in terms of natural gas. I think we have willing customers over there for our product, and so I think, in terms of the natural gas transport, processing, export, there's a lot of opportunity. If we go from, again, 1.5 BCF a day to, say, 5.5 BCF a day, that's a more than 3x increase. You've got more volumes that need to be handled, and that's where we're more focused on the volumes, right? We're not so focused on the pricing. More volumes flowing through pipes, more volumes flowing through plants means more plants that need to be built, means more revenue for these companies.
All right, what are your top producer holdings right now?
We like, obviously, Canadian Natural Resources has been our top holding, and it's funny, it was a source of funds to fund, trades into other, Cenovus and Imperial Oil primarily over the past couple of years. But if you look at this company and what they've amassed, they were big buyers of different assets. They bought Painted Pony for, I don't remember what it was, $4 a share back in the depths of the pandemic. This is a company that acquires countercyclically and produces a lot of cash flow when the cycle is high, and that's where we're at right now. Their net debt position, going down to that $13 billion number where they start to return 100% of free cash flow to shareholders. They're saying 2027, if the strip starts to come up to where the spot prices are, the strip is still down in the $70 to $80 level. That's going to keep coming up as this crisis goes on. We saw the oil inventory draws from the U.S. yesterday. Massive 17 million barrels came out of storage in the U.S. last week. That's going to push that long end price up, and that means that's going to happen sooner for C&Q. So we really like that holding. ARC was our other biggest holding, ARC Resources, which has been acquired by Shell, I mentioned earlier. So we are replacing that with Tourmaline over time. We'll wait and see how this ARC deal goes. It's 75% stock, so it's a difficult thing to know, should we be selling here and moving into the next thing, or waiting and seeing what happens to share prices globally.
All right, we got to wrap it up there, Ryan, but thanks as always for joining us.
Thanks, Roger.
Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. And yesterday on Market Call, we were joined by Javed Mirza. He is an AA quantitative technical strategist from Raymond James. He was covering technical analysis. His topics were Tourmaline Oil, Intact Financial, and Brookfield Infrastructure. Today on the show, we have Gordon Reid. He is the president and CEO of Good Reid Investment Counsel. He'll be taking your questions on U.S. equities. Just ahead, why Canada could get a bill for $1 billion for hosting the World Cup. $1 billion bill is heading Canada's way for the World Cup. CTV's Andrew Johnson has more on how that stacks up against other host countries.
With the transformation of Vancouver and Toronto into World Cup cities just about complete, excitement is building.
I think it's great to see the festival here and all the games and everything coming into town. Money well spent.
A cost that's now eclipsed $1 billion, according to Canada's budgetary watchdog, to host 13 games in June and July. That's roughly $82 million per game, which is actually less than Russia spent to host in 2018, Brazil in 2014, and South Africa in 2010. But one sports economist points out co-hosting alongside the U.S. and Mexico, what we're paying for doesn't quite compare.
We're not getting any of the major elimination matches. We thought that if we were hosting the World Cup, we would actually see something of consequence.
Close to $500 million for FIFA is coming from Ottawa, the rest provincial and local, to pay for security, infrastructure, and stadium upgrades. The host cities are counting on a big benefit. BC's premier says the tournament will bring 1 million visitors to Vancouver over the next 5 years. The mayor has led the charge.
This is an amazing opportunity. It's going to be a month-long commercial.
Critics claim otherwise.
I've been saying for 8 years now, give or take, that we were sold a false bill of goods, not by FIFA, but by our politicians.
How do Canadians feel? Well, the latest polling from Leger showed close to 3/4 of Canadians support hosting World Cup matches, but a majority indicated their biggest concern is taxpayer costs. And the final number isn't in yet. Andrew Johnson, CTV News, Vancouver.
Okay, turning now to new data released by Stats Canada indicating that Canadian travel to the U.S. continues to decline. CTV's Rachel Aiello is following this story and joins us now with more on this. Rachel, thanks as always for joining us. Break it down. What are the numbers showing us? How few Canadians are going?
Yeah, good morning, Roger. So the latest numbers from Statistics Canada show that the trend is continuing of Canadians going to the United States less and less. So the numbers for March, the most recent month they've been able to track, 2.6 million Canadians took trips south of the border. That is a 6.4% year-over-year contraction. So this is now the 15th consecutive month in which the number of Canadians traveling south of the border has decreased. The numbers were slightly up from February, but still overall tracking a decline in the number of Canadians going to the United States. But I think it's worth noting at the same time, the percentage of Canadians or the number of Canadians that are traveling internationally, choosing to go other places, is increasing. So this isn't just simply Canadians because of affordability challenges aren't traveling, Roger. This is they are actively choosing to travel elsewhere.
And where are they going then? What places are they choosing? Are they staying at home? Are they going to Europe? Where are they taking me?
Yeah, so StatsCan doesn't get that specific in terms of where exactly they are going. They're kind of breaking it down in the latest numbers between are they returning from travel from the United States or abroad, international, other countries. So I think take your pick in terms of where Canadians might otherwise be going, but the numbers do also show, and perhaps because of the value of the dollar is better for them, that Americans are continuing to come to Canada more, which is an interesting contrast given how strongly I think a lot of Canadians are feeling about the United States and Americans. Clearly, the Americans are still willing to come and spend money in this country.
Anecdotally, it seems some of them are coming to apologize. But what about the CUSMA trade renegotiations? What kind of an impact is that having, especially as we head into the big summer season?
Yeah, so this data from StatsCan makes a deliberate point of noting that this trend has been observed in direct correlation to the rising trade tensions between Canada and the United States, now existing for over a year. And so while we're anticipating those CUSMA renegotiations to heat up over the summer, talks to revive, likely more headlines, Donald Trump tweets or Truth Socials about Canada, we could see that sentiment among Canadians reinforced. Clearly, it's still going strong here in terms of the numbers of Canadians still actively choosing not to spend their money in the United States, choosing to travel either locally in Canada or travel elsewhere. So I do anticipate over the summer, while we may see just the number of Canadians traveling to the United States go up generally, it is likely still going to be part of this trend of broadly it's down from what it has been. And again, a reemphasis of, because of the tensions with the United States, Canadians still making a point of doing what they can to show their displeasure at a country that continues to tariff us.
Okay, Rachel, thank you for that update. Appreciate it.
Anytime.
Rachel Aiello from CTV News. Well, customers have lodged an increasing number of complaints over alleged maple washing against grocers, resulting in investigations and thousands of dollars in fines, according to the Canadian Food Inspection Agency. CTV's Abigail Beeman has more.
Do you tend to look for origin on what you buy?
Yes, I do. I try to get Canadian.
Trade tensions with the U.S. have many shoppers looking to buy Canadian, and they aren't happy about maple washing, the idea of marketing a product as Canadian when it may not be.
It's not fair. It's not right. I want to know where it's coming from.
People are trying to sort of vote with their dollars when it comes to what they want international policy to be.
The Canadian Food Inspection Agency says complaints are on the rise, 400 since early 2025 when the U.S. trade war heated up.
We need stronger penalties, we need greater enforcement, as well some kind of a certification mechanism would help.
Not all products at Canadian grocery stores are even required to have their country of origin listed. There's no official logo for Made in Canada, and according to the CFIA's own website, a maple leaf on a product doesn't necessarily mean it's Canadian.
Classic situations of false representations or misleading advertising.
Joey Zukran is one of the lawyers behind a yet-to-be-certified class action lawsuit taking aim at a string of stores with examples like a maple leaf beside a can of soup that says product of USA and tomatoes advertised as a product of Canada when the package says product of Mexico.
The allegations in the lawsuit are clear that this was done to attract or touch on the sensitivity that many Canadians have shopping especially in these times.
Of the big retailers, only Sobeys and Loblaw responded to a CTV News request by deadline. Both acknowledged some isolated incidents they say they worked quickly to fix. Loblaw companies were slapped with 2 of the 7 fines the CFIA handed out.
And that was CTV's Abigail Beeman. Coming up, we'll be looking at some of the early stock movers on Bay and Wall Street. Take a look at some of the markets and some of the movers today. First up, the TSX. And one of the companies we're seeing, Lightspeed, under pressure. But right now the TSX is off, or is up by a quarter point. It's turned around nicely. And Lightspeed, you can see it is off, though. It's being dragged down 9.7% based on its fourth quarter adjusted earnings decline. And it also saw adjusted earnings. I also saw an increase in revenue. Dax De Silva, the CEO and founder of Lightspeed, will be joining us at 10:10. So coming up very, very shortly, talk about what's going on there. And also Intuit is taking a hit right now. It's off, look at that now, 20%, on pace for largest percent decrease since March of 2003 after the tax preparation software company reported its third quarter results and gave an outlook. It also said it is cutting about 17% of its staff, and so you can see it's really taking that hit today. Some of the quotes from Barclays, still overweight. The growth outlook is likely not enough for investors. QuickBooks and, more importantly, TurboTax were both slightly below expectations despite bullish comments from management in March. And Evercore saying this was a taxing quarter as TurboTax comes in a little light and MailChimp remains a drag. They said the results were in line at an aggregate level, but a shortfall in tax, even a small one, is likely to fuel concerns about AI disintermediation. Okay, coming up next, we've got NVIDIA's beat, SpaceX IPO, and soaring energy prices. We'll break them all down. Stay tuned. And welcome to the second hour of The Open. I'm Roger Peterson. Thank you for joining us and sticking around if you are. Let's take a look at some stories we're following in the BNN Bloomberg newsroom. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from the Canada Pension Plan. The returns were also helped by holdings in public equities and real assets. The results fell short of the fund's benchmark portfolio, which returned 13.2% for the same period, boosted by heavier exposure to large tech companies. And we'll find out more when Amanda Lang speaks with John Graham, president and the CEO of CPP Investments. You can watch that interview on Taking Stock Friday at 3 p.m. Eastern. Shares of Stellantis are under pressure in today's trading after the automaker unveiled a $70 billion turnaround plan. The major reset includes focusing roughly 70% of investments on key brands, including Ram, Jeep, and Fiat. Stellantis will sideline Chrysler, Alfa Romeo, and Opel. The strategic outline also includes a new savings goal and aims to boost profit and raise returns in North America and Europe by 2030. Shares of IBM are moving higher, up 5.6. The American company will receive $1 billion US as part of the Trump administration's investment in quantum computing. The government is pledging a total of $2 billion US, with a grant also going to global foundries developing specialized chips for quantum computing. The investment will give the U.S. government a stake in the companies. And a turnaround for the TSX after the start was in the red. It is up now by about 0.27% south of the border. U.S. markets flipped around a little bit. They're recovering as well after a slow start to the morning. You can see they're back around a wash almost. S&P 500 still down by 0.14, but Dow's a wash, and the NASDAQ is off by 0.22, but has recovered. Well, NVIDIA has done it again, beating analyst expectations, adding to the excitement. SpaceX is planning an IPO, reportedly eyeing even up to a $5 trillion valuation now. And the fragile Iran truce and stubbornly high inflation, though, are keeping investors on edge. Lots going on today. Joining us now to talk more about it, Teresa Schutt, Chief Investment Officer at Harborfront Wealth Management. Teresa, thanks as always for joining us.
Thanks, Roger. Great to be here. Good morning.
Yeah. Well, it's a mix. I guess a bit of a mixed morning.
It is.
Let's start with the Iran peace talks. There was optimism yesterday. Today, not so much.
There were. I mean, I don't know if we can call them peace talks anymore. So, I mean, at one point he indicated that the administration was in the final stages of negotiations. A deal was around the corner. But things have really turned. I mean, look, it's been 6 weeks since Trump had paused, Operation Epic Fury for a ceasefire. But frankly, talks to end the war have really shown little progress. Tehran has accused Trump of plotting to restart the war. And as we saw today, I mean, they're refusing to give up their uranium stockpiles. And so we're seeing the bond market react clearly. We're seeing the equity market react. And I think, that the supply shock is real. Once the stockpiles start to diminish, we'll continue to see that upward pressure on crude. So I think, there's an argument to look through the noise, but I don't know how much we can tell ourselves that anymore. This is not going away. And this isn't a 3 to 4 week or 3 to 4 month problem when it's over. I mean, this could have lingering implications for 9 months up to 18 months.
And the big one, of course, inflation. We're seeing projected inflation now maybe 6%.
Correct.
What does that mean?
Yeah, so this is interesting. At some point, the inflation had been trending towards that 2% goal through 2025, early part of this year. As we know, the war has completely changed this dynamic. Rising energy prices have sent, most inflation measures to 3%. And as you mentioned, now the forecasters have now said it's going to be up to like 6%. And so what we're seeing is obviously the bond markets react. This has been notable because, as we know, the vigilantes always step in, and they're really signaling now that central banks are running out of time to contain inflation. There's still concerns around unsustainable government finances and possible stagflation that could set in. We saw bond markets in the UK, Japan, and the US all reach 12 months high. So this is no longer kind of a US problem. The 30-year, as we know, Treasury yield hit 5.2%. And we've seen the 10-year inch back up to 4.6% today. So what this means is really, the Fed has to catch up to the bond market to avoid losing control of borrowing costs. Really when a central bank falls behind the inflation curve, this becomes bearish for bonds. We saw with the Fed minutes yesterday, it appears that the Fed, the majority of officials have indicated that interest rate increases would be necessary if the Iran war continues to aggravate inflation. So now the market is, I think, pricing a 40% chance of a hike. So a very different picture than where we started this year, for sure.
All right, let's talk some earnings. NVIDIA came out, another blockbuster, yet. The markets react going, not good enough.
Exactly. I think that's a good way to put it. I mean, look, NVIDIA is really considered the barometer for the health of the AI market. Chips are used in virtually every data center in the world, which powers all the largest AI models. And so their earnings become this kind of bellwether for the entire AI trade. And when their numbers are strong, it tends to lift, or, it's the tide lifts adjacent names like AMD and Broadcom. Now, the market kind of already expected this. And I think, much of this was priced in. I mean, investors bought the rumor, but it is quite striking. I mean, revenues of $91 billion, that's a quarterly sales growth of 62% year over year, a number that would be, frankly, impressive for a startup and is unbelievable for a company of NVIDIA's size. So I think, with that, there were also some important announcements. As we know, NVIDIA added $80 billion to its stock buyback program, hiked its quarterly dividend to 25 cents from a penny. And I think that is reflecting the pressure that they were under as their peers have been, basically releasing 80% of their cash flow to investors. So I think this is, a change as it were. They've also changed their quarterly earnings structure, which I think is interesting, into these two market buckets. Data center and edge computing. I think the market is still digesting what that means going forward. They're moving to fortify their market position. They have to, frankly, because really these hyperscalers are pouring funds into developing their own custom chips. And so, they really have to hold on to that dominance. But I think now that, this last kind of big AI earnings release is out, as you've noted, the reaction has been muted. I think really the market's now going to shift back to Iran, to the bond market, and to the energy crunch, which we're still facing.
All right, I want to get your thoughts before we go on SpaceX. Now, are we hearing a rumor of $5 trillion valuation?
Yeah.
Let's just say 10. It's going to be $100 trillion.
Yeah, it's a lot. I mean, it's they've obviously filed, so we've had a peek into their financials. Q1 revenue of 4.7 billion, but an operating loss of 12 billion, so still not profitable. But I think it's going to be really interesting. I mean, their approach seems to be to use Starlink, which is profitable, generate the cash to bankroll the next rocket, and then use this money then to support their new AI business, which is today kind of a money guzzler. And so this is, I think, a big move in the market. And then following that, of course, we've got OpenAI that could potentially file on Friday, and then of course Anthropic. And these three companies are huge. What this means is that if they were to actually IPO, AI could become 70% of the S&P 500. And to that effect, where does the capital come from? Investors have to sell other holdings to get access to this. So that could have or create some chaos for the market. And of course, if there's too much supply, that could impact valuation. So it depends on a lot of factors. Obviously, the timing, really understanding the financial picture of these companies, and of course, the public float. Like, how much are they actually going to list? And hopefully, the regulators can work with that, and when they can actually be part of the index. So I think this could have big implications this summer. So it's going to be an eventful summer, I think, going forward.
All right, not everybody's going to be at the beach then. Teresa, thanks as always for joining us.
My pleasure.
Teresa Schutt, Chief Investment Officer, Harbourfront Wealth Management. Well, shares of Lightspeed Commerce are under pressure this morning after the Montreal-based point-of-sale company posted its fourth quarter results. We'll talk to the CEO when we come back. Shares of Lightspeed are under pressure this morning after the e-commerce and point-of-sale company posted its Q4 results. Joining us now is Dax Da Silva, CEO and founder of Lightspeed. And Dax, thanks very much for joining us.
Thanks for having me.
You had a net loss, $28.6 million, compared to last year, which $575 million, but that had the goodwill impairment charge of $556. So a little more than last year if you take away that big impairment charge. What some of the reasons behind it?
Yeah, I mean, as a company, we're looking at typically an adjusted free cash flow. For the year, we generated $18 million and $73 million in adjusted EBITDA. So we have some depreciation of formerly acquired assets that contributed to the net loss, and that should conclude at the end of this quarter. And so, looking at the year, we just finished our first fiscal year. We're really excited about the results after that full year of transformation. We have a 3-year transformation plan. So, ending the year at $1.2 billion of revenue, crossing that threshold, as well as generating free cash flow, as well as location growth grew 11%. That's a high water mark from 5% in the first quarter of the fiscal year.
So 15% year over year with what you were just saying. How do you see that continuing? What's going to drive it?
Yeah, so we've been doubling down on our two growth engines as a part of our transformation. That's retail in North America and European hospitality. We grew in those two growth engines, which now, post-divestment, we divested an asset called Upserve, which was U.S. hospitality, a non-core asset. And now those growth engines in FY26 make up 75% of our business. They'll trend to 80%. And in those growth engines, we grew 24%. So really, really top tier growth, and the location growth is coming, from those markets. That's also an 11% growth in GTV. That's all the transaction volume. So that I think sets up the company for to really win those markets where we have the right to win, where we have a great product market fit. We serve complex retail verticals in North America, and we're the leader in full service restaurants across Europe.
And what kind of competition are you facing in those two sectors? What gives you that confidence that you can grow those numbers?
European hospitality is very fragmented. It's country by country. We're the only pan-European solution. So if you're opening a restaurant chain or switching from a legacy system, Lightspeed is the solution. So we just closed a very, very popular chain in Europe called Gaucho. It's an Argentinian steakhouse, across the continent, but primarily in the UK. In North America retail, we're very, very strong in our key verticals: sport and outdoor, which includes bike and golf. And running, ski shops, very, very strong multi-brand apparel, jewelry, home and garden, because we integrate with the brands, we integrate with the suppliers in those key verticals. So we go beyond point of sale. We go into integrating with their key vendors and giving them workflows that nobody else can offer. And now with AI, building agents that take a lot of the challenges of those complex, tedious, laborious workflows that are extremely time-consuming and human-intensive, and offering agents that can give those folks that are doing that critical buying piece, options for assortment, negotiation. All of these elements are being built out, and we've got a rapid development velocity and pace of delivery. So we're excited about how that's trending for the company.
Okay, excuse me. On software, your subscription revenue grew only 6.2%. Below your medium to long-term targets, and your SaaS ARPU decelerated as well. What's happening there?
So we are lapping price increases from earlier in the year. Growth engines for the year grew 15%. So in our non-core markets, we're cross-selling and upsell less than we are in our growth engines, where we've got much richer product suites. So we're seeing a lot of vitality on the growth engines, which, as I said, in FY27 will make up 80% of our revenue.
All right, and just bigger picture, your everything you do is, a lot of it's connected, obviously, to consumer spending. Any concerns about that slowing down?
So we've had a very constructive macro environment for Lightspeed and its merchants and the consumers that buy generally high value inventory this whole fiscal year. So that's been a positive. And we see same store sales in our key verticals, like I referred earlier to golf and bike, home and garden. Some of those supplies were heavily purchased during the pandemic, and so we've seen muted sales in the interim years. But now we're seeing a lot of new purchases in those verticals, and we're very heavily penetrated in those verticals. So that's been constructive for the company as well. And of course, in European hospitality, they've had very, very strong seasons. I think tourism in Europe is widely regarded as very strong.
Okay, Dax, we have to wrap it up there, but thank you very much for joining us.
Thank you.
Dax De Silva, CEO and founder of Lightspeed Commerce. Coming up, while more Canadians are flocking to ETFs, tax complications and U.S. dominance are raising major red flags. We'll break down the numbers next. Time now for the ETF report. Younger Canadians are piling into ETFs, but a massive slice of the overall capital is flowing straight across the border into U.S.-listed products. So does this pose an existential crisis for the Canadian investment ecosystem? Joining us now to unpack the latest data is Ellie Ufest, Executive Director of the Canadian ETF Association. Ellie, thanks very much for joining us today.
Great to be here. Thanks for having me.
All right, just how do the two compare? How much money are Canadians investing, and how much of it is staying in Canada?
So the latest figures that we have in terms of the size of the market here in Canada is just under $800 billion assets under management in Canada. Now, if you compare that to the flows into the U.S., Canadians incremental to that, in addition to that, own about $300 billion. And so more than 30% the size of our current ETF ecosystem is held by Canadians outside of the Canadian market.
And what does that mean then for Canada and for the people themselves? We'll just start with Canada. What does it mean for the country?
It has massive implications. I mean, everything from government tax revenue to jobs to regulatory oversight. I mean, the implications are quite profound. And so something that the association has been advocating for is to try to find ways, both from a regulatory and tax perspective, to stem that flow. So that way we can keep these jobs here in Canada. So that way the government can benefit from the revenue. That way our fund managers benefit from the money staying here in Canada. The exchanges benefit from it. The entire ecosystem benefits, obviously, if we can find a way to incent Canadians and convince Canadians to keep the money here in Canada rather than sending it down to the United States.
Now, in theory, though, when people cash out, when the money comes, doesn't it come back into Canada at that point?
Potentially. I mean, I don't exactly know why Canadians are investing in U.S. listed ETFs. Maybe they own assets and investments in the U.S. and they need it to fund those investments and those assets. Maybe they plan to retire in Florida one day and use that money for retirement outside of Canada. But what we do know with certainty is that once the money leaves Canada, it benefits no one in the Canadian ecosystem. It benefits no one in the Canadian marketplace, except for perhaps those investors that are investing in U.S. ETFs. But it doesn't benefit government. It doesn't benefit our fund managers. It doesn't benefit the Canadian ecosystem. It doesn't benefit Canadian employees that work in the ETF marketplace.
And for the investors themselves, what kind of tax implications are there for them?
So there are a number of ones, and of course, I'm not a tax lawyer or accountant, but what we found was, interestingly, 65% of Canadians, according to the latest research that we're doing, are not even aware that there is a different tax treatment between how those ETFs are handled between the Canadian and U.S. markets. And so we dug a little bit deeper into that, and we asked, okay, if 65% of Canadians aren't aware of a tax difference between the U.S. and Canadian markets, how does that look among ETF investors? And so surprisingly, more than a third of them, 36%, are unaware of tax differences. And even among those that own U.S. listed ETFs here in Canada, almost half, 45%, have no idea that U.S. listed ETFs are treated differently from a tax perspective. And so it's incumbent upon perhaps the ETF ecosystem and all of the stakeholders to educate Canadians that there might be tax implications, and especially if Canadians are unaware of what those implications are, it's incumbent upon the industry to now figure out ways to tell them about those differences, and perhaps even the government needs to step in and figure out ways to tell investors about those differences.
And it's younger people that are leaning towards the ETFs. Why is it there's not comparably ETFs here, or what's drawing them south?
Yeah, so overall, ETFs obviously are not a niche investment product. Overall, across Canada, 20% or 21% rather, 1 in 5 Canadians owns an ETF, which is a pretty substantial number, obviously. Younger Canadians, however, though, to your point, are more inclined to purchase an ETF. 1 in 4 or 25% of younger Canadians do it. And there's probably a number of reasons behind that. Based on other research that we've done in the past, we know that younger Canadians are also more inclined to do it yourself, use an online brokerage account. We believe that it's because there's some sort of gamification component to it where they can buy and sell in real time and watch the tickers go up and down. And so younger Canadians are more inclined to do it yourself. We know that. They're less likely to work with an advisor. And that's probably the reason why they're over-indexed, if you will, in terms of their ownership of ETFs.
And then you mentioned earlier about bring maybe regs to help control this a little more. What would you like to see?
So the association is advocating for a number of things. We're just in the final throes, if you will, of submitting our federal pre-budget submission. But a number of the things that we've been advocating for the past year is a Maple Investment TFSA account to encourage Canadians to invest in Canadian domicile, Canadian listed ETFs. And so the idea behind that is if a Canadian chooses to keep their money here in Canada, they will get a higher investable limit in their TFSA with a government matching program for individuals earning $90,000 or less. And so we know that Canadians are not saving for the future. We know that almost a majority of the money is held in cash. And so if we incent Canadians, if we educate Canadians to take that cash that sits idle in a TFSA and they invest it, the benefits are obviously going to be compounded over the lifetime of that investment. Okay. It'll benefit the Canadian economy, and that's one of the things that we're going to be advocating for in the coming months.
Okay, we have to wrap it up there, Ali, but thank you very much for joining us.
Thanks very much for having me.
Ali Ufest, Executive Director of the Canadian ETF Association. Coming up, NVIDIA had a blowout quarter. Is now a good time to buy the stock? We'll get some insight after this. Well, NVIDIA reporting yet another record quarter with sales and profits beating expectations, seemingly suggesting that there's no slowdown in sight for the AI trade. NVIDIA, of course, provides chips to leading AI model developers, including OpenAI and Meta, and it's the world's most valuable company. Let's get more now from Ivana Deleska, founder and CIO of Spear Invest. Ivana, thank you very much for joining us today.
Thanks for having me, Roger.
Another one for NVIDIA, but the market today is saying, we expected it.
Yeah, well, Roger, interestingly, the numbers came out very strong, especially the guide for next quarter, over $90 billion. So while NVIDIA investors were positioned for a strong report, the implication across the value chain are actually pretty positive. So we're seeing a lot of the component suppliers, like their partner for CPUs, ARM, or their networking suppliers, those stocks are going up much more than NVIDIA, which is seeing a bit of a muted reaction to the numbers.
And that $90 billion, is that realistic?
Yeah, absolutely. And we believe that it could be conservative. What's happening in the second half of the year, they're launching the Vera Rubin platform. But even more importantly, as agentic AI takes off, and we're in the early innings of that, they're going to be selling a lot more CPUs. So they guided on the call for 20 billion incremental CPUs. And we believe that this could be conservative.
And what gives you the confidence with it? I mean, I think everybody is now starting to understand AI, and now agentic is the next phase. What makes you think it's going to take off as much as it will?
So, Roger, if you look at what's been happening, the first wave of AI was really mostly model training related. And really, you would be prompting these models and getting a one-off response. What we see coming next is these models that are reasoning and iterating. And that's really what Anthropic's really strong revenue is based on, right? So they launched their new model, Opus, and they've seen just a skyrocketing revenue to like over $40 billion on an annualized basis in a matter of few months. So we think that these are early signs that agentic adoption is coming, but we're going to see more of this with OpenAI rollouts, with enterprise adoption. So yeah, we think we're in the early innings, but Anthropic's revenue is really the first sign that we saw.
Okay, and with Vera Rubin, what makes this the next level? What takes it to the next level?
Well, with each generation, the key is tokens per watt. So they're really like using the power unit that you have to generate the most tokens possible. And basically, as we go from generation to generation, the tokens are becoming much more accessible, broadening applications to a much wider range. So NVIDIA, we believe, still remains the leader in terms of cost per watt. We're seeing competitors like Google coming up with the TPU, the AMD chip. They also have strong value propositions, but nothing really compares to NVIDIA for general purpose computing.
Okay, and I have to ask, I'm going to say I'm asking for other people, but tokens, what exactly is that? What's that concept?
So that's basically AI usage. That's how AI usage is being measured. So every time you go and prompt ChatGPT for something, you are generating tokens. So it's interesting because some of the tech companies now are measuring people's productivity, like employee productivity, in terms of how many tokens have you been using, right? So that means that you have been productive and using AI and generating insights. So that's a key metric as we go forward to monitor the usage of AI.
And I think one of the big things still, $0 from China. Does it need to get into China, or can it even, do you think?
Well, we think the boat for NVIDIA to sell revenues to China has sailed. They still may be able to capture a small part of that market, but really the opportunity was to capture that market early. Now the Chinese companies are developing their own internal solutions. They're nowhere near as good as NVIDIA, but they're compensating for it on the software side. So we think that while companies still may like it, the incentives are not quite there for NVIDIA to sell to China. We expect that it will be a small market for them, but nowhere near as big as it could have been if they were able to sell these chips early to China.
Okay, and we have to talk about this one. SpaceX, the IPO, we're finally seeing some numbers. What do you think of those numbers?
Well, Roger, the key thing with SpaceX is launch, right? So as we go forward into the next several years, space is opening up to be a huge potential for several different applications. Data centers in space being one of them, communications being the earlier one, and the one that we're seeing, like the revenues numbers mostly reflect. But the key will be launch, because only SpaceX has been able to prove launching rockets at a reasonable cost where commercial applications can become viable. So we think with their new rocket, the Starship, they're going to be able to significantly drop costs from the thousands, like 3,000 per kilo, to less than 300 per kilo. And that will broaden out significantly the type of applications that you're going to be able to see. And hence the timing of this IPO is really coming ahead of that cost decline.
And so, we're now hearing about $5 trillion for evaluation. Is that realistic?
5 trillion is probably not realistic. I think something closer to 2 at the IPO. But over the long run, I think they can easily trend towards that number. So the first use case that we see today, as I mentioned, is communications with Starlink. I think that's going to be just one of many use cases. So as we develop data centers in space, that's going to be a 3 to 5 year timeline just to prove the concept. I think that's when you're going to be seeing the valuation trend towards the 5 trillion. I don't know that it would be coming out at that valuation.
Okay, we have to wrap it up there, Ivana, but always a pleasure to talk to you. Thanks for joining us.
Thank you.
Ivana Delevska, founder and CIO of Spear Invest. Coming up, Hot Picks. We'll zero in on 3 plays in the industrials when we come back. Time for Hot Picks, and today we are zeroing in on 3 plays in the industrials sector. Our next guest is highlighting some work in nuclear. For more on this, let's get Maxim Suchev in here, Managing Director of Industrial Projects at National Bank. Maxim, thank you as always for joining us.
My pleasure.
Okay, let's get right to it. AtkinsRéalis, nuclear is having a little bit of a renaissance, isn't it?
Yeah, absolutely. Even though the share price is actually down 8% year to date, as the market is somewhat concerned about how AI could potentially impact the engineering business. But we do strongly believe that, when people make a parallel to software, for example, it's not the same sort of dynamic as with civil engineering. And what's exciting right now with Atkins is the fact that, you would have seen the federal government is going ahead with its electricity plan. And by extension, nuclear is taking center stage in Canada. And right now, Atkins derives roughly 25% of its top line from nuclear, but more than 40% of its value as a percentage of net asset value is driven by this end market. And when you look in Ontario alone, we think that both OPG in Wesleyville and Bruce C will be selecting technology later this year. And we do strongly believe it's going to be CANDU reactors. And by extension, Atkins is going to be in a prime position to develop this, very safe, non-enriched uranium technology, which is also indigenous to Canada. I'm still actually kind of bewildered by, some of the news flow right now where people are, speculating that maybe another technology could be selected. For us, clearly that CANDU is the right one, and ATRL is the major beneficiary of building out that capacity.
And with going back just to the AI, I mean, all these industries, a lot of them manage to, they incorporate new things. I just think to CAD, when they brought computers in for engineering, I'm sure everybody thought that was the end of a bunch of things then, but you incorporate, don't you?
Roger, you make such a very good point. Engineering consulting has been evolving for many years. We've seen, as you correctly mentioned, CAD, parametric design, etc. What actually is happening on the ground right now is that you get a better product ultimately delivered by the consultants, which enables, better sensitivity, modeling for the clients, better forecasting, and ultimately faster and higher quality delivery. So we are agree on that point, even though the market is still somewhat undecided in terms of how the business model of engineering is going to evolve over time.
All right, let's get into building things, Aecon.
Yeah, absolutely. To be honest, it's the same sort of thematic exposure. So nuclear is 28% of the company's top line. Utilities, another 18. So basically anything, if you think about sort of electrification for the next decade plus, more than 50% of the company's top line stems from this very important vertical. Obviously, Aecon is up dramatically on a year-to-date basis. It's up 50%. Has come off somewhat recently, but we do view it as a buying opportunity. And historically, it was also a business that has had some run-ins when it comes to execution. What has happened over the last couple of years is that the procurement methodology has evolved dramatically for the government projects. So we think that the possibility of potential cost overruns is just much less. And if you look at the percentage of contracts which are not fixed price for Aecon, it's more than 70%. So the business has evolved in a positive direction. Market exposure is very positive. And when you look at the valuations of US peers such as Quanta and Mastech, which are trading at 25 times EV to EBITDA, Aecon's 25 times PE valuation actually looks like a bargain in comparison. So we are extremely bullish on construction. And to your point around AI being a potential sort of question mark when it comes to engineers, construction entities are actually viewed as a sort of safe from AI plays, and hence the share price performance on a year-to-date basis.
And if you're going to build things, you need things to build those things. Finning International.
Yeah, exactly. So you need the equipment. And so when you look right now in Canada, for the longest time, we're sort of shying away from a development of commodities. And right now you look at the narrative change around pipelines, LNG, et cetera. So 50% of the company's top line is driven by Canada. And we do think that on a prospective basis, the outlook is dramatically better. Copper, which is part of Latin American business for Finning, is 40% of the top line. And obviously, copper is in a very healthy position right now. We do expect more projects coming to market. Argentina, which could be another interesting way to participate in the development there. It's only 5% of top line right now, but we think it could be as much as 10% prospectively, driven by copper, lithium, etc. But ultimately, it's a dramatically better execution under the relatively new CEO, Kevin Parks. And you have, when you look at actually the ROE generation, it's up from 13% in 2019 to north of 20% right now. So massive turnaround in terms of actual fundamental performance and all.
Oh, I think we're having some technical difficulties. Maxim, I don't know if you can hear me, but we've lost your audio there. We apologize for that. We were almost out of time, but thank you as always for joining us, and hopefully we can get that issue fixed. That was Maxim Sytchev, Managing Director of Industrial Projects at National Bank. Well, coming up next, we'll hear from JP Morgan CEO Jamie Dimon on rising bond yields, inflation, and AI transformation. JP Morgan Chase CEO Jamie Dimon says that rates risk going much higher after bond sell-offs. We got perspective from him in a Bloomberg interview on the sidelines of the bank's Global China Summit in Shanghai.
It's always reasonable in the investing world to be nervous a little bit because you've mentioned the opening. There's a lot of geopolitical risk. You have a bunch of wars going on, which I hope are properly resolved. You have bond rates going up. Inflation is a little bit higher than people thought. But I'm not surprised. I think when people say you should be surprised, bond rates can go up. The notion that somehow people said they'll never go up is the wrong notion. And so companies like us prepare for higher rates, lower rates, and figure those things can happen. So.
The thing is, they're at the highest level in decades. I mean, that is where the surprise could be. I think
they could be much higher than they are today.
Oh yeah?
And,
how much higher?
You say decades, but we've had like one of the greatest bull markets, other than brief COVID. Since the great financial crisis, we've had a huge bull market, huge lower rates for the most part for a long period of time. But the world changes. Like we may have gone from a savings glut to not enough savings. The AI investments, you're talking about in America alone, $450 billion last year, $750 this year, $1 trillion next year, global deficits at all-time highs, and they are huge. So the governments, including ours, has to borrow huge sums of money, more next year than this year. And so, people who own bonds, they tend to look at these things, and both inflation and demands for capital can push up rates.
The thing is, it's not just an inflation story right now. It's also, I guess, a credibility story, right? I mean, we have an environment where everybody's trying to pay debt, and governments around the world have so much debt at a higher level. I mean, at some point, it's going to hit.
Yeah, it is going to hit. Like, U.S. government debt is $30 trillion. The average rate is 3.5%. So even today, they can't possibly refinance it at lower than that rate. They have another $2 trillion to do this year. But the thing is, we don't know when. We don't know when the world gets too scared about that, when inflation makes it where people don't want to own long-term duration securities, or when it's just a demand for capital. There have been examples in history where there's so much demand for capital, rates are going up, but it's for a good reason. People are making productive investments in the world. Government spending is often not that. Government spending is much more consumption related, which doesn't help future productivity. So, all that spending too drives corporate profits. So people shouldn't be that surprised that corporate profits are doing quite well too, which helps obviously the stock market.
The question, I guess, if I could get you to look at the crystal ball, right? And what yield would that be spillover to the economy, to policy, to markets?
Yeah, so I'm very cautious about crystal balls because I don't think anyone has a crystal ball. We look at all potential possible outcomes, and you'd be surprised, from recessions with inflation, from recession with no inflation, from home prices down 40%, stock price down 40%. It's a wide range of outcome. I think when people think this is our forecast, that's what's going to happen, I think that's an intellectual error. I think you should be much more thinking about range of outcomes, possibilities, probabilities. And for us, we want to handle all of them so we can serve our clients. So I'm not that worried about, our profits going down and the stock going. That doesn't worry me at all. I want to serve our clients and do a good job. And I do worry about the geopolitics for the future of mankind. That's a far more important issue in my mind. But just looking forward, I think it's my own view, and it's just different than other people, is that rates can easily go up more and credit spreads can go up more.
And everything's going to be okay, even with rates going up more?
No, at one point you're going to have a lot of people who have to refi at higher rates. So there's this general assumption that, I can refi all this debt at roughly the similar rate. Well, if credit spreads go up, people, companies, and governments will have to pay more. And so that can put stress in the system and easily could cause a recession type thing. Again, I'm not terrified of recession other than, it hurts people who get laid off. But I think as a scenario, that's a very possible scenario.
There are risks. People have called time on the credit market. If yields continue to rise, there'll be a lot more pressure on the credit market.
Yes.
How might that play out?
Well, a lot of companies are leveraged. There's about $5-6 trillion of leveraged loans out there. They're going to have a hard time refining at those rates. The equity values will be considerably less. Some will be prepared for it, some hedge for it. A lot of people didn't hedge for it, so which means that people don't think about it normally, but that means they're taking interest rate risk, and that they should be very cautious when you take interest rate risk. And so this, as you said, this could put pressure on the system.
High yield. There's been so much demand for it. Never mind that inflation is sticky. Is this worrying or not?
Well, you mentioned at the top there's a little bit of exuberance in the marketplace.
Yes.
Personally, I'm not a buyer of credit spreads. I am not that interested in what other people do. I would not buy credit spreads at these levels. And other people have other views, but a lot of people out there, remember, they have passive funds buy it. People have to meet indexes. There are a lot of reasons people have to buy, and they're just trying to create a little bit of alpha for themselves, as opposed to would you go absolutely long credit spreads or not. So I would have the luxury of saying we don't have to. Now, of course, we're in the business, so we continue to make loans that I think may be more stressed than people think, but that's part of a long-term strategy. That's not because I like it at this price.
But the thing is, there's so much demand. What's behind that demand? Is it that complacency, I suppose?
Yes, but demand changes. People forget sentiment. If you look at, what happened before the crash of '73, or the crash of '82, or the bond market of '94, or the crash of 2000, that was all true. And then things change. And even if things change about when people talk about liquidity, well, what happens when things get tough is sentiment changes and people want more cash. And so the liquidity requirements change. Money supply changes. Central banks change. Banks pull back. And that all can pull liquidity out of the market at precisely the wrong time. And when people need cash, they sell risky assets. So am I predict that's all going to happen? No, but I wouldn't be surprised that happens.
It's not just about markets, it's about AI, it's about tech. I mean, JP Morgan has come out to say it is actually a tech company that just happens to be a bank. You have a huge tech budget, I think $9 billion, $3 billion for 20 billion, and then I think $3 billion for cybersecurity. Talk to us about how you're mobilizing that capital. Where are your areas of priority?
So we don't actually deploy capital by saying we'll put capital there. We in everywhere we do, in every business, we grow in China. Like here, if you look at just China, we've gone from banking 10 companies to banking, I think it's 200 or 300. We've gone from banking 30 multinationals coming here to banking 600 multinationals coming here. And as we serve them, it deploys capital. So the deployment of capital, the deployment of loans are an outcome of building the business. That's true for every country. It's true when we open branches in the United States. It starts to demand capital as people give us deposits. We start to make loans. So we are pretty comfortable we can deploy capital intelligently, serving clients. We don't deploy capital like an investor saying, oh, this is the best place to put it. It's a kind of an outcome of how we kind of grow the business.
In terms of AI, though, I mean, how are you investing?
Oh, absolutely. Well, AI, if you, or at any business meeting we have, and we've been doing it for 13 years, at every business meeting you have, we talk about how you can use technology to do a better job for your clients. What are the projects you have? So we're using AI for risk, fraud, marketing, design, document management, who you should call in the morning, Salesforce type things, branch location, hedging, and it's the tip of the iceberg. It's moving very, very quick. Coding, it's moving very quickly. So we want to just stay up there and use AI to serve our clients, and we're going to do that. How can I do a better job for our clients using a technology called AI? Just like we did it with a technology called digital, a technology called cloud, and way back a technology called mainframe. Like, it's no different. We got to do a better job for a client because that's how we compete.
All right, let's take a look at some movers on the markets right now. First up, we're going to bring up Lightspeed Commerce. It is slumping right now and down 7.77%, and that's on its Q4 earnings, EPS, and its guide. It's left a little people a little uncertain about where it's heading next, so they were concerned about that. Another one we want to take a look at quickly, a couple actually, Walmart, and it is off as well. Oh, sorry, we're going to D-Wave first. Sorry, that's we're getting at it. That was my fault. We're going to D-Wave first, and it's soaring right now. Take a look at that. It's up nearly 25%, and that's a lot of the quantum stocks down in the States. D-Wave, of course, formerly out of Vancouver, on the rise after the U.S. Commerce Department confirmed that it planned to award grants to nearly a dozen companies to foster the development of the domestic quantum industry, and D-Wave taking advantage of that, and other computer companies as well. IBM Business Machines was up 4.8%. Now, Walmart's the other one we want to take a look at, and it's down more than 7%. Now, for the year, still up about 6%, and investors expressing disappointment in their earnings outlook. Walmart reporting the slowest growth in a key sales metric in 2 years and provided a downbeat profit outlook. And that wraps up this edition of the Open Morning Markets. Up next.